Good afternoon, everyone. Happy Thursday, and welcome back to all of our market rebels and live streamers on YouTube and Twitter. It's absolutely great having you here. We do this every Monday, Thursday, Friday, 4 p.m., broadcasting live here in beautiful Delray Beach in South Florida. And if you've been with us for the past few sessions, you know we were talking about vertical spreads. And sometime last week, I think it was Friday, I said that you don't want to do a credit spread just because of the word credit. And unfortunately, that's the sole reason why a lot of traders do it. The whole idea is, well, I'd rather get paid than have to pay. And as I showed, you're getting paid to accept a liability. And that doesn't make it bad. It just means that it's a tool. We have to know when to use it and when not to use it. And of course, and that opened the doors to another good question. Well, when are the times that you should choose a credit spread over a debit or a debit over a credit? And so that's what we started this week, going to do it all week long. And on Monday, I talked about reason number one, and it is for skews or mispricings in the market. And that might be a reason that you would lean towards a debit or a credit or vice versa. Today, we're going to talk about reason number two. Tomorrow, we'll talk about reason number three. And again, these are not the only reasons for using debits over credits or vice versa. They're probably the three most popular. All right, so number one that we talked about Monday, again, was skews. What's number two? Well, number two has to do with what are called morphs. Actually, more about the ease of the morph. So for those of you who have been trading with us for a while are all too familiar with morphs, who have done our Q&As. We talk about them all the time. They're some of the most powerful ideas behind options. And a morph very simply just allows us to change the shape of the risk graph. That's a real simple definition. So maybe I've got a long call. I could sell a call at a later time and leg into a vertical spread. That would be a very simple morph. All right, now some of the more complex ones, maybe I could buy a put, same strike as a long, and go into a back spread. There's a lot of different things that we can do to change the shape of these risk graphs depending on what's happening in the market, whether with prices or with volatility. So the ease of the morph is going to be our second main reason for choosing a debit over a credit or a credit over a debit. And here's the thing that you want to remember. Debit spreads morph easier in the same direction, meaning that if you were bullish before in your vertical spread, that you're going to be bullish after. Sometimes you'll hear us say that they morph easier in the right direction, right? Meaning that it's in the same direction that your outlook was previously. All right, so debit spreads morph easier in the same direction. Credit spreads morph easier in the opposite direction, or sometimes we'll say in the wrong direction. Wrong direction means that maybe I was bullish going into my vertical spread, and suddenly it's like, oh, thing flipped on me, now it's bearish. It's going the wrong way, at least from my perspective. And with a credit spread, it will be easier to morph if it flips on you. So again, these are two very powerful reasons for choosing one over the other. And what you're going to do, it's a very simple morph, is to buy back the short option. In both cases, whether you have a debit spread or a credit spread, the answer is buy back the short option. So jot that down if you have to. I'm going to be testing you through it as we go through this, but that's always what we're going to be doing. So that's the key. Okay, so let's start with the bull spreads. Now, if you remember from the vertical spreads, I said that there were two basic flavors. You have bull spreads and bear spreads. And within those, we have debit spreads and credit spreads. So there's four basic types of spreads. Now, for this presentation, I'm just going to do the bull spreads just for time. You can do exactly the same thing with the put spreads in the opposite direction, or at least with the bear spreads. So let's start with the bull spreads with calls. Let's say that you buy the 100-105 vertical call spread, and let's just give it a net debit of 3. Now, if you were with us a couple of weeks ago, you know we talked about some pricing principles and showed that lower strike calls have to be worth more money, assuming we have the same expiration. And notice what you are buying in this case. If you are buying the call spread, you are buying the more valuable option. That's what's giving you the deltas. This 105 over here is just a hedge. So we're going to buy the 100-105 vertical call spread, and this is our risk graph. We get our bends at the strike. We can see our first bend right here at 100, the second one at 105. There's our long 100 call. There's the short 105. So if we look at the max loss, which was our debit, which is 3 down here, max gain, of course, is 2. All right, so for those of you who might be new, remember that you have the right to pay 100, the obligation to sell for 105. So that's 5 points. That's the most this spread could ever be worth by itself. So if you paid 3 for it, the most you're going to put in your pocket on a net basis, the profit is 2. So that's where those numbers are coming from. Now, what it's going to do with a morph is you are going to go from bullish to even more bullish. Remember that a debit spread morphs in the same direction. So, or in the right direction. Okay, so that's the benefit of a debit spread morph. What was the rule? We're going to buy back this short, and all you're going to do is eliminate this cap. Right? That's all we're doing by buying back that short. So the rule was buy back the short option. Here's the short. It was a short 105. We simply go into our broker's platform, buy the 105 call, execute it, and you've now eliminated this cap. Why? Because those options cancel. It's just a closing transaction. And so when it's all over and done, you're just going to be left holding the $100 call. Notice it's the lower strike. It is the more valuable one. That is the one you'd like to hold. So we're going to do this for our morph. We were on the blue graph, and now we've gone to the red. So you can see very easily we have kind of shifted or opened up the doors, maybe would be a good way to say it, for this. Used to be a capped maximum gain of 2. Now it's unlimited. And for the call world, that's truly unlimited because there's no theoretical price on how high a stock's price can go. So now we've really opened up the doors for much bigger profits than 2. However, there is something you have to be very careful of before you do this morph. And I talk about this a lot in the Q&A. Traders often forget that when they break this apart, you have to add that payment back into your cost basis. So in this example, I showed that we paid $3 for it, but that was for the vertical spread. I might have paid $10 for the option for the long one and sold the short for 3. That would be a net debit of 3. I'm sorry, for 7, and that would be a net debit of 3. I might have paid $20 for that long option and sold the short for 17. That would still be a net debit of 3. So if I buy this back, too many times traders go, oh, I'm in it for $3. No, you're not. You're in it for the cost of that long plus any payments you had to pay to buy back the short. So this is going to be the result. Yes, you do open up the upside, but you've also increased the maximum loss. And this is why you have to be careful with this type of a morph. Okay, so just kind of keep that in mind. If you paid $3 in this example for the debit spread, you're not in the long option for 3 by any stretch. Okay, so buying back the short on a debit spread keeps the same directional bias. That's the important thing to see. Notice that the blue was bullish, limited bullish, but it's still bullish. And the red is bullish. And we got to the red by buying back the short. So again, this is why we say it morphs easier in the same direction or in the right direction. What's the answer? Buy back the short. And you're going to go from your vertical spread to a long call. Now, if we were doing it with the long put spread, the bear spread, you would do the same thing. Buy back that short put, and you would just be long a put. Okay, so that's the first morph. Let's take a look at the second one, a bull spread with puts. Now, I know for some of the new traders that might sound odd, but remember, we can get to the bullish and bearish side with calls and puts. If you are using puts for a bull spread, it has to be a credit spread. The person who buys the put spread, person who's buying the more valuable put, is obviously bearish. Taking the opposite side of the trade by selling it means that you are now bullish. So let's say that we sell the 100-105 vertical put spread, and it's a net credit. All right, so how do we know that that's a credit? We'll go back to your pricing principles. Higher strike puts, what we talked about, have to be worth more money. That's what you are selling. If you're buying the put spread, you're buying the 105 strike. If you're selling it, you are selling the 105. That's what's driving this strategy. And that's why it becomes a credit. All right, so let's say that we do this trade for a net credit of 2. And look at that, we get exactly the same risk graph. That's why I said in a previous one, we don't do a credit spread just because of the word credit. It's exactly the same thing. They're both debits from your broker. So we get exactly the same graph. We start with a credit of 2 up here. So here's our long 100 put. Here's our short 105 put. Again, we get our bends right there. Here's our credit of 2, but we have an obligation equal to the difference in strikes of $5. And that means we might end up losing 3. And look at that. We're right back to a max loss of 3 and a max gain of 2. So it's exactly the same thing. Now, if we want to morph this, what do we do? What was the rule? Buy back the short option. So we can go from bullish to bearish, though. Remember, it's going to flip. This is a bullish bias. We need the stock price to go up. But our morph is going to take us in the bearish direction. So what was the rule? For the credit spreads, they morph in the opposite direction or in the wrong direction. So what are we going to do here? We were bullish before. Something has changed in the market. We want to morph it. The rule said to buy back the short option. Okay, and when you do that, you're going to eliminate that put. You're just going to be long the 100 put. So we're just going to buy that 105 put. Those cancel out. We're left with 100. And that means we have gone from this blue graph to the red. Okay, so we were bullish beforehand on the blue. We've now gone to the red, unlimited, at least down to a stock price of 0. But we've opened up the doors. We used to have limited gains if the stock went up. Now we have unlimited gains if the stock falls. We've flipped directions and we've opened up the downside. So this is what we mean when we say that a credit spread morphs easier in the wrong direction or in the opposite direction. Okay, so we've lifted that up. Nice little morph. So remember that buying back the short on a credit spread reverses the directional bias. That's something you want to start memorizing. It'll help you to understand the morphs and why you might use a debit over a credit or credit over a debit. So as always, you have to account for those costs. Too many times traders think that they're on this red graph. You might really be down here in the black. That doesn't mean it's a bad idea. Just be aware of that, especially if you're in a really volatile or a high price stock, something like a Tesla or an Amazon back before the split when it was trading at $3,000 or almost $3,500. Yeah, you might be paying $80 for an at-the-money option. And if you morph it like this, you might have said, oh, I'm in the vertical spread for 3, and you morph it, and now you're into it for 85. You need to be very careful about why, which is why there are better ways and certainly things you should consider before doing these morphs. This is why we usually do them after some rolls, things we'll be talking about in the future, but right now I just want you to understand the basic morphs. Okay, so you might end up increasing the maximum loss. All right, now for a little side note, we said with a debit spread, they morph in the right direction. Can you reverse a debit spread? I just said that debit spreads go in the right direction. Is it possible to reverse it? Well, from what we've talked about before, calls or puts, puts or calls are the same thing. The answer should be yes. So how do we do it? Well, let's go back to our debit spread with calls. What was the rule? Buy back the short option. But notice that we're dealing with calls here. If I flip it, instead of buying back the 105 call, if I buy the 105 put, what happens? These don't cancel. But what do we have? We have a synthetic short right here with a long call. Okay, so there's our synthetic short, and we've now gone from the blue to the red. So this is why we say that the debit spreads morph easier in the right direction. Can we morph them in the opposite direction? Sure, we just did it. But now things get a little sticky because now I've got a synthetic short position combined with my call. It's not quite as clean and neat. So if you knew that up front, that we might be morphing this into the opposite direction, you'd probably want to do the credit spread. But the answer is that we can do it in either case. Alternative question, can you maintain the same direction for a credit spread? Before I said a credit spread goes in the opposite direction. What if you wanted to go in the same direction? Sure, we can do it. Let's go back to our credit spread with the puts. Instead of buying the 105 put, which was our rule, we're going to buy the 105 call. So now they're not going to cancel out. Now this is a synthetic long position, long call, short put, combined with a long put, and that is what? A long call. So yes, if it really comes down to it, we can morph in the same direction with a credit spread. It's just not as clean and easy. It starts to get a little messy. Of course, for more advanced traders, this might be exactly what you're looking for another leg of a different strategy. Those are different discussions. But right now, I just want you to know that we can certainly do any of these combinations. But the basic reasons for these morphs is that if you know or have some inkling of an idea that you might be morphing it, the debit spread morphs easier in the right direction, the credit spread morphs easier in the wrong direction. So now that we've covered that, very quickly, why might we use them? Well, let's say that we're, at this point in time, we're seeing the stock starting to fall, or at least this is our thesis. And we go, okay, so here's my trade, and I want to put on a vertical spread, bearish, because this is my outlook. But I also notice these moving averages down here. And I go, you know what? I kind of think it's going to go shooting straight through there, like this. But I also notice these moving averages. What if it does this? What if it reverses on me and reverses hard? What would I want to do here? Well, this might be the time to do the credit spread because it will morph easier in the wrong direction. I was bearish. What if it flips on me? That should be your clue. Credit spread might be the better choice. Okay, what else? Let's say we see something like this, candles coming up from underneath. We're back here at this point in time. I'm bullish. This is my outlook. And of course, I'm expecting it to go shooting through, but I'm sorry, let's say that I'm expecting it to do this, to hit the 50-day moving average and go sideways. I see these moving averages up here. I go, I don't know if it's going to get through there. But what if it does? What if it does this? I was bullish before, but I'm just even more bullish after. See how that's going in the same direction? In a case like that, I might choose the debit spread. All right, so those are some things to think about. Another alternative reason why you might choose a debit over a credit, but if you get nothing else from these, understand, do not do a credit spread just because of the word credit. All right, so quick recap. Why use a debit or credit spreads? We talked about on Monday, pricing skews. Reason number 2 is what? Ease of the morph. And reason number 3, you'll have to wait until tomorrow. That's what we're going to be talking about then at 4 p.m. But in the meantime, is this a new way of seeing options for you? And if it is, it's going to open new doors to your trading, and that can only mean better results. And if it is, please give this number a call here, 815-957-9125, and schedule a free 30-minute one-on-one call with one of our world-class coaches, many of them with decades of experience of market trading, market making experience on the floors, can lend invaluable insights specifically tailored for you. And so we'd like to extend that to anyone who is watching and says, you know what, I do need a tune-up on my trading, and here's a really good way to get some fresh ideas. So the number again, 815-957-9125. And with that, I look forward to seeing you tomorrow for reason number 3.